Well, hello, everybody, and welcome to another whiteboard session here at the Equity Trust Company virtual classroom. In today's program, we're going to be talking about partnering multiple self-directed IRAs to buy and sell real estate, whether it's residential, rental properties, fix and flip transactions, private lending, mortgage notes, trust deeds. You're going to learn that you can partner multiple self-directed IRAs together, even within your own individual family, in order to buy and sell real estate. And the catalyst of today's program is so many investors that have approached me across the country that have said, John, I don't have enough money in one individual IRA, but I have enough money across multiple IRAs within my family unit, or my IRA money and my non-IRA money, in order to get started. So let me jump right into an investment example so you can understand this concept of partnering multiple individual IRAs, known as partnering multiple disqualified persons together on an individual transaction. Because what you'll learn in terms of the rules is that when you're partnering with disqualified persons, which for all intents and purposes are immediate family members, you have to make sure that all profits and all expenses flows proportionate with the capital contribution. So here's an example of that. This is a property that I bought in March of 2020, and I partnered my Roth IRA, my traditional IRA, and then my non-IRA money to acquire the property. It's a duplex right outside of Cleveland, Ohio, renting out at $750 per unit, $1,500 gross rent per month, about $1,100 to $1,200 net operating income on a monthly basis. Cash flow, this is an all cash purchase. There's no loan on this property. The cash flow on a consistent basis is anywhere between a 14.5% to 16% cash on cash return on investment is what we're projecting. The $63,000 purchase, I partnered my Roth at 55%, my traditional at 35%, and my non-IRA money at 10%. So at closing, the title company received a wire transfer, 55% of the 63 from my Roth, 35% of the 63 from my traditional, and 10% from my own bank account. So it's a 55, 35, 10% split. And when you look at the deed to the property, you'll see Equity Trust Company, custodian, FBO, my Roth IRA, undivided interest, 55%, my traditional IRA, undivided interest, 35%, and then my non-IRA money, undivided interest, 10%. So it's a 55, 35, 10% split in this particular scenario. All of my expenses must flow proportionate with that capital contribution, 55, 35, and 10. My initial $2,000 in repair costs split up 55, 35, and 10. And then, of course, all of my rental income is split up as well, 55, 35, and 10. So I have to make sure that I split up all the expenses and all the profit allocation proportionate with this capital contribution, because I'm considered what's called a disqualified person to my IRA. So in order to mitigate a self-dealing prohibited transaction, I make sure that all my profits and all my expenses flow proportionate with that capital contribution. Another example, a private loan. Wayne and Alicia from New Orleans made a $106,000 loan to a real estate investor. This was actually a real estate rehabber. And this particular real estate rehabber used that $106,000 from Wayne and Alicia's Roth IRAs to buy, renovate, and resell a property. That particular property sold, and they made a $114,000 profit. Alicia's Roth IRA funded 25% of the loan, and Wayne's Roth IRA funded 75% of the loan. So there was one promissory note and one mortgage. The lender listed as Equity Trust Company, custodian, FBO, Wayne's Roth IRA, undivided interest, 75%, and then Alicia's Roth IRA, undivided interest, 25%. They didn't just charge interest, they charged what's referred to as an equity participation. So they received 33% of the net profit. The net profit was $114,000. So 33% of $114,000 is $37,620. This is what's referred to as an equity participation promissory note and mortgage. So that $37,620 was split up 25% to Alicia's Roth and then 75% to Wayne's Roth IRA. And this is a Roth IRA. So another important principle to take away from this particular segment, beyond just being able to partner with disqualified persons, is also the Roth IRA is a tax-free account. So Wayne and Alicia produced $37,620 in tax-free profit. Had they done this deal outside of their Roth IRA, they would have had to pay interest income taxes on that $37,620, which would be subject to their ordinary income tax rate. Instead, it's all in their tax-free Roth IRA. Now, in terms of who are disqualified persons and who are not disqualified persons, well, the Internal Revenue Code is exclusive rather than being inclusive. So we're told who are disqualified persons. Everyone else is not considered a disqualified person. So disqualified persons to your IRA would include yourself, your parents, your grandparents. Under 4975 of the Internal Revenue Code, they refer to these individuals as lineal ascendants. And then there are lineal descendants under 4975 of the Internal Revenue Code, which of course would be your children or your grandchildren. So just think of it this way. Anyone up and down the family tree is considered a disqualified person to your IRA. Your spouse is also a disqualified person to your IRA. And then here, any LLC, corporation, entity, S-corp, joint venture partnership, trust that is owned 50% or greater by these aforementioned disqualified persons is also considered a disqualified person. So for all intents and purposes, your real estate investment LLC or other entity is considered a disqualified person to your IRA. So you need to make sure that you're not engaging in a transaction. If you're going to partner those multiple disqualified persons to one another, you want to make sure that all income and all expenses flows proportionately, just like we talked about. If you had a disproportionate profit allocation between these disqualified persons, then you would effectively trigger a prohibited transaction. And if you trigger a prohibited transaction, your IRA would cease to exist January 1 in the year in which that transaction occurred, which means the IRA would be fully distributed. If you were under 59.5, you would have a 10% premature withdrawal penalty and ordinary income taxes. So of course, one does not want to engage in those types of transactions. That's why investors make sure that they're following the process and they're making sure they're very cautious as they execute on these individual transactions. Last but not least, I will mention that if you partner with a non-disqualified person, so somebody outside of this, if you will, ecosystem, you partner with a non-disqualified person, then you could potentially disproportionately allocate profits. In the next segment, we're going to talk about a real estate investment joint venture, the capability of partnering with a non-disqualified person, where maybe you only put a small amount of capital into, for example, a fix and flip deal, but through a money partner that's not a disqualified person to you, you can split up or negotiate a disproportionate allocation of the profits. So that's a real estate joint venture with self-directed IRAs and a non-disqualified person. Stay tuned for that next program. Thank you so much for joining us on another whiteboard session.